Hi, my name is Mike Sowers. I'm the CEO of Commercial Investors Group, and I just want to thank you for taking a look at potentially becoming an investing partner of our firm. First thing I'd like to do is walk you through two different ways that you can invest with us. The first way is to make an investment directly into a property, and the second way is to invest in our CIG Value Add Fund. We have these metrics on our website, so I'm just going to skim over them. But in general, there's benefits to both of these methods. And the biggest indicator of which method would be a better fit most likely is going to be this investment timeline. So if you're looking for more like 2 to 5 years, the investing directly in a property would be a better fit. Investing in a fund is really for long-term investors who want that retirement cash flow, that long-term mailbox money. And that fund is based on not only growth of your capital, but cash flow as well. Now, it's not to say that investing in a property wouldn't generate cash flow, but our business model is to invest in distressed assets, and I'll go through our acquisition criteria here in a moment. Both of these fall under different SEC exemptions, and you have to be accredited for the fund, and it's preferred that you're accredited if you're going to invest in a property. Accreditation is net worth of $1 million outside your primary residence and an income of $200,000 for each of the last 2 years, or $300,000 if you're married for the last 2 years, and then expecting to do the same. Sorry, I said and, it's or. So a net worth of $1 million outside your home or meeting the income qualifications, okay? If you're going to invest through an entity like an LLC or an IRA or a 401k, you can do that. All of the owners or holders of the ownership need to be accredited in order for the entity to be considered accredited. Our fund is a $100,000 minimum investment. Our investment into properties varies, but generally it's in the $50,000 to $100,000 range. The preferred returns are 6% if you invest $100,000 to $249,000, 7% if you do $250,000 to $499,000, and 8% at the $500,000 plus. We do distribute dividends quarterly. The expected returns based on the private placement memorandum, which is the only way that there can be an offer to invest. So this presentation is just for informational purposes. Please read the full private placement memorandum. But as you'll see in there, it's a 10 to 12% projected annual dividend. So essentially 2.5% to 3% per quarter, and then a value growth of 5% of your principal. So your overall yield in the fund should be mid to high teens. Depreciation is a huge benefit of buying real estate. When you invest passively in a single asset fund through investing in a property or a multi-asset fund through our CIG Value Add Fund, you get the benefit of the depreciation. It gets passed through to you. What is depreciation? Depreciation is basically a non-cash expense that we get to offset income. And for some taxpayers, that may be able to be used to offset other ordinary or capital gains income. You need to check with your CPA for your unique situation. In general, the depreciation you can anticipate is about 50 to 75% of your investment in year one, and then the normal 1 to 2% per year after that in a property. If you invest in our fund, you get that first year big depreciation at 50 to 75% of your investment, but then you also get the big depreciations of all the additional assets. And so that's a huge benefit of investing in our fund, is that it's a multi-asset fund and you get a lot of diversification across different asset classes, markets, and things like that. The decision timeline is as follows. When you invest in a property specifically, we do a webinar and you get to choose if you're in or out. When you invest in the fund, you're actually not investing in a property, you're investing in a company. And so you have to understand the business plan. And if you like our business plan and you want to keep your money at work and not get it back every time we sell a property, then you sign a subscription agreement. But we don't take your money at the time you sign that. What we do is we wait till we have a project that we're going to fund, and then we call your money down at that time. We do allow a thing called a 721 exchange into the fund, and that allows you to contribute your property to the fund in exchange for membership units in the fund. So that's the investment options. If you have additional questions, I'm happy to field those. Let me just run through our acquisition criteria so you can understand the types of things we do buy. We buy assets in the 1 to 20 million range, investment grade commercial properties. So office, warehouse, and retail. We're looking for class B and C assets that are multi-tenant with smaller units. We love dealing directly with business owners, and we like to have diversification across a large tenant base of different types of businesses. Value add and core plus basically means we like them when they cash flow a little bit, but not too much. We want financially distressed assets where we can renovate them, lease them up, take over the property management, increase the occupancy, increase the rent rates, decrease turnover, decrease expenses by creating efficiencies and solving complex problems. And that's how we can create more value in a property than it costs us to do so. What we don't want is fully stabilized assets. We're not in the business of going and paying top dollar for nice, pretty properties. We want something we can sink our teeth into and solve a big problem. So we do a lot of different things that way, but that's our general business model. Now I'm going to run you through how the actual partnership structure works. So at the top here is how the ownership structure is. So let's say we go buy property A. We're going to form a new LLC. Let's say we call it Property A LLC. The ownership of that property is going to be you, the investors, CIG Holdings, which is our corporate entity. And then if there's a franchisee involved or a local operator, they would be a part owner as well. Both our franchisor entity and the franchisee get paid an asset management fee for putting together the deal and overseeing all of the day-to-day management. The day-to-day management is overseeing construction, leasing, and property management. And then we do all the accounting at Commercial Investors Group Corporate, so you know that all the books are airtight and everything's being done the same across all assets. And then we have a third-party auditor that verifies our books every year before the taxes are done. So let's talk about how the cash is distributed. The term waterfall is simply a term for who gets paid, how, and when. So here's how it works. During the holding years, which is cash flow from rent, it falls under this category on the left. At liquidation is at the time of a refinance or sale. They're very similar, but there's some slight differences. So let me walk you through the two different ways. So on the left here, you're going to see waterfall during operating years. So the rent's going to come in. And the first thing is we charge basically a real estate commission for putting the deal together. The franchisee gets 1% and the franchisor gets 1%. Then all the property expenses are paid, which includes that asset management, accounting, and property management fees we talked about earlier. Those are always not to exceed market rates for those items. And there's a lot of value that we create in exchange for those, and those are customary in this business. The next thing that gets paid is the mortgage or the bank. And then there's this bucket here called the preferred return. That's for you guys. Essentially what a preferred return is it's a mortgage payment to the investors, but it's an interest-only mortgage payment, and that interest is set depending on the amount of your commitment to the partnership. So the commitments vary, so I won't go into those, but you can check the documentation. Generally, they're going to range in the kind of 6% plus range, and they can go up if you make more substantially sized commitments. So here's why we don't call it an interest payment. An interest payment must be paid. A preferred return is earned no matter what, but it's only paid if there's enough cash flow to pay it. So let's say we buy a vacant property and we don't have enough cash flow to pay a preferred return. You're still going to earn it. It just accrues on your account. If we pay part of it, then the part that we didn't pay accrues and you get paid the other part. So any cash flow, if we didn't pay prior quarter preferred returns, you get paid the accrued preferred returns first, and then we pay the current quarter's preferred returns. Whatever's left over from there, we check to see if we have any reserves that are less than we should have in reserves. So we keep reserves on hand for like 6 to 12 months worth of mortgage payments, reserves for capital improvement items that are going to come up in the next few years, and reserves for operating capital. If for some reason some big equipment system went out unexpected and we needed reserves, we would use operating cash to replenish that reserve reservoir. Assuming that doesn't happen, then the remaining cash is called the distributable cash, and it's distributed 50% to the investors, a third to the franchisee, and 17% to the franchisor's holding company called CIG Holdings. So that's how the cash gets distributed during the holding years. Now, if I take a step back out and I go over here to Waterfall at liquidation, here's what happens when we sell a property. So when we sell a property, the sale price comes in, we pay all the closing costs. Sometimes we charge a disposition fee, sometimes we don't. If there's a broker involved, generally that will go to the broker. The bank debt then gets paid off. So we pay off the mortgage, then we give you any accrued preferred returns that weren't paid from prior periods, and then you get all of your money back. We keep anywhere from 10 to 25,000 in final reserves for expenses that would come up after we distribute this final cash. And then generally we'll wait 6 to 12 months, and anything left over then would be distributed a second time. But basically that's how it works. And whatever's left over is your profit. And we split that the same as the ownership, 50, 33, 17. So I hope that this didn't overwhelm you. Feel free to check it out again. We tried to keep our structure as simple as possible. And again, we appreciate you taking a look at our investment. It is a private, exclusive investment. We just get so excited that we're able to bring these opportunities to help people really diversify and get their hands in an asset class that's not only time tested, but it's reliable, it's stable. And even in the market's up and downs, the returns may vary slightly, but it's consistent. And that's, what we have is a proven track record. We've done several $100 million in deals, and we've been delivering phenomenal returns to our investors. You can check out the current private placement memorandum to get all of the details, to take a look at the investment criteria that we're using at the time and what you can see for expected returns. So thanks for checking out this informational presentation. Feel free to submit your information or book a call with us to learn more. Thanks.